Financial markets often appear calm on the surface for long periods of time. Prices move slowly, news feels predictable, and investors grow comfortable with the environment. Then suddenly, something changes. Prices begin swinging more aggressively, headlines start mentioning volatility, and many people wonder what exactly caused markets to become unstable so quickly. At first glance, volatility often seems tied to a specific event. A central bank changes interest rates, a new economic report surprises investors, or geopolitical news appears. But in reality, markets rarely become volatile because of one single moment. In most cases, the system had already become sensitive long before the first large price movement. During long periods of stability, investor behavior gradually changes. When markets remain calm for months or years, people begin assuming that tomorrow will look similar to yesterday. That belief slowly influences decisions. Investors may take slightly more risk, use more borrowed money, or move more capital into assets that promise higher returns. Each individual decision might appear reasonable, but together they quietly change the structure of the financial system. This is where leverage becomes important. Leverage simply means using borrowed money to increase the size of an investment. While it can increase returns during stable periods, it also amplifies losses when prices begin moving unexpectedly. When many investors rely on leverage at the same time, small price movements can trigger selling as investors try to reduce risk or meet margin requirements. That selling pressure can push prices lower, which forces more investors to sell as well. What started as a small disturbance can quickly turn into a larger wave of market movement. Liquidity also plays a major role. Liquidity refers to how easily assets can be bought or sold without dramatically affecting their price. During calm markets, liquidity appears abundant because buyers and sellers are active. But during uncertain moments, many investors prefer to step back and wait, which means fewer buyers remain in the market. When that happens, even modest selling pressure can move prices much more than usual. Psychology reinforces this process. Humans naturally assume that recent experiences will continue into the future. If markets have been calm for a long time, stability begins to feel normal, and risk appears smaller than it really is. When volatility returns, that perception changes quickly, and investors begin adjusting their expectations. From this perspective, volatility is not random chaos. It is often the result of a system adjusting after a long period of stability. The same behaviors that create calm conditions can slowly build the ingredients for future instability. Understanding this helps explain why volatility often appears suddenly. The underlying pressures were building long before the headlines began talking about it. If you enjoy learning about the hidden psychology and mathematics behind financial systems, consider subscribing to the channel. New videos explore how money, markets, and economic behavior interact over time. And if you found this explanation useful, leave a like and activate the notification bell so you don't miss future videos.